basic requirements I look for when I'm assessing a tender document would be making sure that the organisation have completed all the information, that they are financially robust, that they have the capability and the capacity, and also to make sure that they perhaps put something in that differentiates themselves from other competitors. So there are lots of opportunities that are available within the private sector, and these fall into a number of categories. So financial services and banking, retail, telecoms, travel, utilities. But I guess for a lot of you it's around how do you find those opportunities, how do you come across them? And some of them are online portals through customer relationships that you have. Some of them will be advertised in newspapers and trade magazines, and a lot of it will be built through networking, so an understanding of the customer base and networking with customers. And then we come on to, is it right for our business? So think carefully about before you're actually applying for a contract. So do we have the capability? Do we have the capacity? Do we have the resource? And do we need to actually make investment? But most important, is it actually going to be profitable? I mean, that's the key thing to remember. So this is the procurement and tendering process that we go through. It's a procedure that we go through according to the type of contract that we're actually working with. So we've got an open procedure, and this is typically for a small contract, and we would just simply give a date and a time for people to complete their questionnaire or their tender document, reply, and then we would just go through the tender responses, and we would award the contract. The second one is the restricted procedure, and in the restricted procedure we would send out a questionnaire to interested parties, and those would typically just be around questions like around finance, about capability, about standards, and so things like data protection, security, just to make sure that you can actually meet the requirements to deliver the services. And once people have satisfied that or applied in that questionnaire, we would go through that questionnaire and select a number of suppliers. Once those suppliers have been selected, we would send out the invitation to tender. Then there's the competitive dialogue process, and this is for the slightly more complex contract. So if it's an outsource or if it's a big, typically IT type contract, then it's the competitive dialogue. And again, this follows the selection process. And we'd get down to probably one supplier, and the likelihood then is we'd go through a full negotiation before contract award. And then negotiated procedure, where a buyer enters contract negotiations with a number of suppliers. So it could be 2 or 3 or 4 tenders that are all meeting the requirements, but because of the size and the nature of the contract, we want to negotiate with all 3 or 4. And it could be in that situation that we actually award to more than one supplier. Many opportunities are really low value, and they're actually quite resource hungry. So you have to question whether that's really what we want for our business. And some of them might just be that it's too big. So, we look at a contract and we look at the value of it, and do we actually have capability? Well, probably not. So we're best to walk away. And that's a really important thing to consider before you actually enter into applying for the contract. We map this and we look at the value and we look at the effort. So I've just done one here as an example. And typically, if you look, business as usual, the value is actually quite high, and the actual resource requirement is quite low. What do I need to invest? Well, investment as far as effort and value is concerned is probably middle, and technology and transformation is probably medium as far as value and effort is concerned. So this one to me looks like a contract we should be applying for. I mean, the big thing for us when we're considering and we're reviewing contracts is where is the value, what's differentiating the contract, the tender from other competitors. So things like savings, that's important for everyone. Everybody wants it to be less than it is today. Technology, technology forms a key part today for ordering, for processing, etc. And then customer experience, what can you add, that's different to enhance that customer experience? You need to understand what's going on in the market. I also need to understand what my competitors are offering. So just being very me too isn't good enough. I need to understand what other people are doing.
Had a single source supplier versus a consortium that offers either equivocal or pretty much the same service. Is there a penalty, or is it looked?
We look on it very favourably because we have a number of contracts who do use subcontractors. The key to that is making sure that the lead contractor, in the contract details that we have, it absolutely is clear about subcontracting. You know, an important part for us is security. So long as you can demonstrate robustness relating to data security, it's not a problem at all. So then there's the stages of sourcing. We've got 6 stages that we would typically go through. So the first phase is establish the scope and the goals, and this is the initiation process. So if I'm looking at a contract that's currently in place, when is the renewal? I need to notify my stakeholders, I need to notify legal, I need to notify the incumbent that we're coming up and we're starting to prepare. And I need to collect and analyse the data. So I need, if before I'm preparing a tender or an ITT, I need to understand what the volumes are, what is the spend that we've currently got in place, so that when that tender is going out, it gives those contractors, those suppliers, an opportunity to quote accurately based on what we're actually doing today. Converge the internal supplier market. So I need to identify the suppliers who I want to invite to bring to the party. So I would do that typically through possibly an advert. So we would advertise that through local media or press. So I would put together a list of suppliers that I want to go out to. The next phase is develop the sourcing and the negotiation strategy. And included in that is what's the criteria for supplier selection and also for scoring. I need to make sure that they have the right financial robustness. I need to make sure that they have the capability, data protection, security. I also need to be clear about the scoring. I just have a basic matrix that scores, and so that I can look at the different contracts and the applications, and I can differentiate them. So that scoring mechanism allows me to whittle it down to the final 1 or 2. And then I need to execute strategy and implement. So once I've gone through the negotiation phase and we've identified the preferred supplier, I will put a recommendation proposal forward to our executive team, who once, if they're satisfied that all of the information has been signed off and approved, they will give the final rubber stamp, and then we can enter into drawing up the contract with the new supplier. And then the final stage, of course, is the managing of the supplier relationship and making sure that they're on track, making sure that they're delivering to what our expectations are. Are they delivering spend? Are they meeting the quality and the service that we're expecting? The content that I provide to the suppliers, it really is critical that the information that I provide to you is accurate, so that because you're going to be basing your pricing and your offering on the information that I've sent through to you. And then from the other side, so the key things that we look for in a tender document, and this gives you as applicants a greater opportunity to put a really compelling story together, and gives you an opportunity to differentiate yourselves from your competitors. And something that I've found really adds value, and it does differentiate, is where people in a contract have actually used video clips. So they've gone down to the shop floor, and the tender document, when I click on it, actually we're interviewing the operators, and I'm actually seeing the shop floor, and I'm seeing the people who are involved on the day-to-day running of the work. And that makes a real difference because it brings it to life, and you get that passion, and it really comes over. Another one that's very important is business continuity. That forms an enormous part of our contract because of the complexity of our transactional print. We need to make sure, because we're so tightly regulated by the FCA, we need to absolutely demonstrate that if we have a breakdown of relationship with our contractor, or if there's flood damage or fire damage, or if there is any situation that they can't deliver, we need to understand what business continuity and disaster recovery provisions that we've got in place, and that's really important. And then management information. We get lots of management information to the point where, it's almost like a cottage industry, but it is really important because I need to understand if a mail pack hasn't gone out or if a marketing print has got information on there that's incorrect. And that management information really does help me in that kind of managing of the contract. So it's important that all of these aspects are included.
Do you look more favourably on suppliers that have multi-sites or single-site organisations that maybe use a specific DRS provider
We've actually got a mix. So we work with a large organisation who have multi-sites, and it's quite a quirky setup that we have in some ways, because our disaster recovery would be provided by one of their alternative sites, but they don't have full capability to produce our check production. For our disaster recovery, if we have a situation where we have a breakdown in relations, or if we have a full disaster and their whole network goes down, and if we need check production, we revert to an external, completely separate organisation for the provision of disaster recovery. So that's a completely separate contract. So I don't think it really matters. I think if you're, as a provider, can move to another site, great. I think you have to think about that breakdown in relations. I think that is something, it's not something we want, and hopefully it will never happen. But there is a possibility, and you need to demonstrate, how you would handle that or propose handling that in that situation. And we need to demonstrate that those contractors who we have relationships with are financially robust. So during the actual tendering process, we would ask for copies of the company accounts. We would get a full report on the history and the kind of the current situation on the organisation we're proposing doing business with, just to look at, have there been any CCJs? Have there been any unpaid debts? Has there been any takeover in the last few years? And if so, we just need to understand, does that create any risk? We have something called the Blue Book, and the Blue Book within Zurich is a standards. It's a document, it's a real live document that sets out the standards for data security and how all information security is managed. And that's around handling of data, destruction of data, systems, what systems and firewall standards need to be in place before we will enter into any work with external contractors. So contractors need to make sure that they are aligned and they're signed up to our Blue Book. And also a full understanding and compliance with the regulator and relevant legislation. So it's important that our suppliers are open and honest and transparent with us, so that if they have had a problem, they share it with us so that we can notify the FCAs. Okay, so if we go on to the negotiating and contracting, a key part is the legal issues. So it's really important that you get that legal input, just to get that kind of belt and braces check. So if it's a full outsource, for instance, it's making sure that the right people are notified. So in our case, we have to notify the FCA. TUPE, so Transfer of Undertakings, Protection of Employment, you'll all, I suspect, be familiar with this. We were outsourcing a team of people who'd worked on the production and the transactional print on site at Zurich. And most of those people were 100% dedicated to the print activity, but some of them weren't. So there's a little bit of a kind of a grey area relating to, are they full TUPE or are they a retained resource? Termination and exit. We need to be clear about what's our exit strategy. We need to make sure that we've got an exit plan, and that's being signed off and approved by our legal team. And we also need to make provision for, if we have a breakdown in relations, and then liabilities. So for instance, if we have a fine, who picks it up? If there are any employment cases, so if anybody goes to a tribunal, if they were previously a Zurich employee and then they move over to the new supplier, if there's a breach or if there's an employment challenge, who's picking up the costs in that? So it's just clear, those liabilities we just need to be absolutely clear on. And then information security, I keep coming back to that because it's something that's quite close to my heart. It's really important that we're absolutely clear about information security, data handling, destruction of data, and all of those aspects relating to information security. KPIs, they're the metrics that allow us to measure the performance of our suppliers. And typically in the print world, you've probably got your service level agreements, and then the KPIs are the things that we measure related with the things that you can improve. So we would set our KPIs relating to improvements that could be made. So relating to print, we've got KPIs that measure the colour, the delivery, the quality, the finishing, the packaging, so that we're always looking for improvement. And it's a way for us, the customer and for the supplier, to work together and kind of improve the service that we've got in place. These are sort of typical things that you would expect to see in our contracts. So compliance with company procedures. So I've referenced the Blue Book. We need to make sure that all of our suppliers are signing up to and follow the rules of the Blue Book. intellectual property rights. So the ownership following the termination, we need that to be clear. Change of ownership and control, we must be made aware. So any change to the organisation, we need to know, we need to understand what that means, if anything, for our organisation. Confidentiality internally with our customer and externally with subcontractors. You know, it's important to protect our customer and our supplier proposition, pricing, competitive advantage. So it's absolutely key that we're all signed up to that confidentiality. And then payment provisions, you know, we've got to be clear right from the outset. I don't want to find that we've signed up to 30 days and we're not being paid until 60 days. You know, those are the sorts of things that become a real irritant. So those would be the sort of typical clauses that we would expect to see in our contracts. Working with external suppliers gives us much more ability to kind of leverage their expertise and leverage the pricing. So managing contracts and relationships, you know, governance, I've touched on governance and controls a couple of times, and it's really important once that contract is landed and you've started to work with your new supplier, that you get the governance and the controls right. It can take a couple of forms. You know, it can be a very contractual governance model, and that's very much around robust controls, contract enforcement, SLA management and penalties. Or the other way is to perhaps be a little bit more collaborative, and that's a relational governance model. And this is around communication, commitment, credibility and compassion. And personally for me, it's been about combining the two. I don't think one is better than the other. But for me, it's about making sure that I've got a strong relationship and an open dialogue with my customer. It's more of a partnership. So the governance are there so that I know who to deal with, who I should be working with, how I should be escalating, and who I should be escalating to. You know, it improves the performance of the supplier. So I think people have got more visibility and more transparency, and the meetings that we have, if there are queries or if there are complaints, you know, I bring those people who are complaining into a meeting with the people so they can explain. And you know, it's all about that governance, that control. You know, if you get that right, it will really help.
And you mentioned savings, technology, customer experience. How important are those things when weighed up against price?
18 months ago, everything was price. You know, we were all into driving down price. Now we've turned a corner. You know, last year we made savings in the area of print and post to the tune of £1.8 million. And you know, we didn't do that by cutting what we're doing. It was just changing things. But it's given us an opportunity now, having made those savings, to start thinking about customer centricity. So starting to think about, you know, what's going to add value, what's going to make a difference when we're sending something out to the customer. And I don't think there's anything wrong as a supplier and you saying to the customer, you know, what is it you're looking for? Is it the customer experience that you really want something different, or is it all about price? And I think, you know, that's that early stage that we talked about. Understand what they're after. 3 top tips for winning a contract through the bidding process would be: understand the tender, make sure that you can meet the requirements, make sure that you understand what your competitors are doing and what's going on in the market, and also make sure that you can provide the capacity, the capability and the resource to deliver.
Today I'm going to talk about how public sector procurement works in the UK, hopefully just giving people an overview of the rules and regulations that we work within, the challenges and constraints that we face, but also the opportunities and benefits for them as suppliers.
Okay, a public contract can be awarded by a contracting authority on only one of 2 grounds. We can either go with the lowest price, which if you look after a very commodity-driven product, that might be absolutely the right thing to do. The other one is what we call the MEET test, which is the most economically advantageous tender. And that allows us to consider other commercial factors, so we can test quality, service, capability, technical information assurance, all the things that Tessa has already alluded to. The idea being that obviously the contracting authority decides which one of those is most applicable for the contract that they're awarding and the goods or services that they're procuring. If you're using MEET as the basis for the award, however, there are also criteria that must be followed. The criteria that you're actually evaluating on must be linked to the subject matter that you're actually asking for in the contract. So we can only evaluate you on criteria that we've actually asked for. However, what we have to do is disclose the criteria and the relevant weightings for these criteria, and we have to disclose that up front. And the criteria and weightings have to be published in the contract notice or in the tender document. So again, up front of you actually deciding to bid for something, you can see what that evaluation will be, you'll see what the weightings will be, and it's all very open and fair and upfront. Policy through procurement is one of the catchphrases that you'll see used, and that is about using procurement to deliver government policy. So some of the political drivers are around, obviously, the sensible ones: deficit reduction. We're in a period of austerity that's not going to go away. Stimulating growth in the UK, obviously, big political message. SMEs, how do we support SMEs? It supports the growth agenda. Transparency. We are really now being encouraged as government to think about what commercial models and opportunities we may want, rather than just a straightforward contract. So big focus, joint ventures, GoCos, government-owned company operated type organisations, mutuals, etc. So that's a big priority for government, and again, that might be something you want to think about. CSR procurement is being used to deliver a number of CSR initiatives. Greening government is one of the agendas on about how do we obviously be more corporate social responsibility on that. I think for me the biggest one, and the one I always take to heart, is actually again the perception. We are actually spending your money and we're spending my money as well. So again, politically we've got to be seen to be doing that right. So it's a really tough environment to actually be a buyer in, because it feels like you are treading on eggshells. You've got a number of competing priorities that need to be delivered. Right, I thought I would cover off the Green Review. And the case for this came about obviously from the review by Sir Philip Green, when he was asked to look at how government were procuring what was then termed as common goods and services. The key findings that he came out with was that we're not leveraging our buying power as government, and nor do we follow best practice, and we didn't have standard pricing or standard models for what were standard goods and services across government. So basic commodities are bought at different prices across departments. Box of paper, anywhere between £8 and £78 a box. Massive discrepancy. The interesting thing though, I think, was the fact that multiple contracts were signed with the same suppliers with different terms and conditions, different pricing, again for the same products and services. We weren't able to really get a handle in terms of what we were spending, how we were spending it. MI was non-existent or shockingly bad at the time of the report, so it was really difficult to be able to actually decide whether we were getting value for money. So this is where the role of Crown Commercial Services came into the fore. For starters, for government, if you've got £40 billion worth of spend, you should be able to use that to aggregate and get a better deal than what you're getting as disparate organisations. And also leveraging the market and benchmarking our prices. So again, if we've got all of this spend, how are we best leveraging that across all of the organisations? We've got a number of objectives that underpin everything that we do. Obviously, service. We need to focus on delivering better commercial services to government. We need to be seen as the provider of choice, not just because you have to use Crown Commercial Services or any other government contract. It's because you want to, because it is best value for money. Savings, again, we've articulated that. That's not going to go away. I work in government, and my God, we are not easy to deal with. And I know that we have inefficient processes, etc. So we've got to get smarter about how we help our suppliers to deliver those savings. Obviously, we want to increase our reach in terms of the amount of spend that we manage on common goods and services, which again is good for the government departments and good for the market as well. And we want to get better knowledge around what we're doing. Again, more informed. The more informed we are, the better choices that we can make. And we rely on our suppliers to help us to get that knowledge and experience. But also we needed to look at areas where we actually needed to do continuous improvement. So focusing on other areas such as commercial and contract management, not just letting a contract and then not managing it properly, which is as what's happened with Serco and G4S. So big focus on commercial and contract management and upskilling ourselves there. Performance management as well, as Tessa said in this morning's session, a lot about MI, a lot about the performance, the metrics, the SLAs, the KPIs, how we actually measure in delivery. Obviously, massive focus on suppliers and supply chain innovation. So actually, are we talking to the market enough? Are we utilising best practice? Where could we be better? And operationally, How do we deliver better? So it's about managing all of our service delivery operations in a better way, but also our engagement with suppliers. I think there was a bit of an arrogance that we as government know what we're doing. We'll write a specification, put it out, and you will respond. That's not the case. It's a case of we need your help to help us to write the specifications better in a way that will allow you to deliver. And I think the really big one, which I'm going to focus on next, is the pre-OJEU readiness, which I think is the part where I touched on before about the market engagement, is actually telling the suppliers that we're going to go out, telling them what we're going to bid for, inviting them to help us to shape that bid, and getting ourselves to be what we call market ready, both in terms of what we're actually asking for, but also in terms of our documentation as well. Francis Maude, for those of you who know him, Minister of the Cabinet Office, mandated lean sourcing. Now, lean sourcing, for those of you probably already operating lean in some of your environments, it's based on the standard Unipart lean process, which is used, obviously started off in the automotive industry and is now being applied across a lot of manufacturing sectors. So the lean principles are that we strip out bureaucracy and eliminate wasteful practice, and we speed up the processes to reduce costs for everybody involved, buyers and suppliers. So what does it mean for me as a buyer? Well, it means greater use of the open procedure. Massive focus on the pre-procurement market engagement, which I've touched on. Testing our thinking, which again is a massive thing. You know, actually asking, are we asking for the right things? Are we doing this the right way? Innovation. Can't stress enough at the moment. Big focus again on innovation, particularly to drive savings, but obviously to improve our processes as well. A really important one is outcome-based specifications. So actually saying what we want, where we want to be and what we want to achieve, not necessarily saying how we want you to do it, obviously save time and cost. You'll also start to see more around use of dynamic marketplace, so kind of an Amazon type activity where for sub-OJEU, which is roughly about £100,000 contracts, is actually we don't need to go through this very convoluted tender process, is actually we can do different things by using more dynamic marketplace. One thing I will say, which is slightly different to the private sector around kind of the lean procurement process and some of the regulations, is that because we're in an environment of open and fair, because it's about making sure the bidders have a level playing field, is actually we can't negotiate. And that's something that's quite different to the private sector. And that's really quite frustrating on both sides. But again, it strengthens the fact why we need to do so much more with the market up front as opposed to in the process when it's too late. So for suppliers then, I've already covered off more time with you up front, less desk-based, more talking to you. I'm going to say simpler processes. You may or may argue that that's not the case, but we're certainly in a period of continuous improvement trying to make them simpler. Certainty of timelines. Again, it's a big investment to ask you to bid for the work, so we need to be able to give you proper timelines that you can work to. You can make sure you've got the resource there to enable you to put forward the best bid you possibly can. And relevant information, that's quite obvious, isn't it? But actually, again, we don't always give you the information that you need, and again, only by talking to you and asking you those questions can we actually put the proper information out there going forwards. And use of e-sourcing tools as well. You're probably all quite familiar now with more and more online systems such as Bravo, Mtoris, Delta, all of those kind of things now. Big move to be using e-sourcing. All but the most complex procurements to be turned around within 120 days. The OJEU and the Bidders Pack, and the Bidders Pack is the ITT, and the standard terms and conditions are all published up front. So it's our responsibility to give you everything up front, particularly is the standard T's and C's. Our T's and C's are actually on our website. What do we need to do after we've procured and after a supplier has actually competed and won this work? The purple line says what we were doing before. So we didn't talk to the market, but we spent a load of time going through the process and then nothing at the back end of it. Big focus now, obviously, we're calling it our new DNA. Focus on where we're going to get the most value, and that's the most value for us as a buyer, but also the most value from you as a supplier. If it's for a commodity product, for example, a pen is a pen is a pen, and surely you can evaluate that on paper. If it's more where it's a service and it's more about the capability and ability of a supplier to deliver that service. If it was a high risk or value or complex contract, I would absolutely want to be meeting with the suppliers. So a lot of pre-market engagement, as I've already touched on. For those suppliers who actually really have got some great ideas, want to add value to government, can see the innovation, can see the waste, is actually this is the advantage now, that we're going to be managing the contracts better, and that gives you the opportunity to work with us to deliver some of the innovation and to drive out some of the costs that are in there. Okay, so supplier management, where do we need to focus on our effort? And we tend to use what's called the 4-box grid. And the axes are its value to risk. And where you sit in terms of the contract value and the risk to the organisation plots you on this chart. If you're top right, that means you're a very strategic supplier to government. So you'll have a different type of supplier management than you will if you're bottom left, where it's a commodity type product, it's either low value or low risk, very straightforward for the organisation. And it's not just where your contract fits to us as government, it's actually where do we fit in your business? How important actually are we? Because we might have a contract that we think is very strategic, very risk critical to us as business, and you're top right. In your organisation, we just may be the nuisance factor that puts us bottom left. And again, that lack of synergy between our expectations and your delivery can mean that there's a risk for government. So it's looking at it kind of through both sides of the coin, really. Then we've got to have a different type of relationship with our suppliers. So big focus at the moment on how we do that and what that looks like. Things like supplier action plans, performance reviews, monthly, quarterly. We have what's called the top 300 now across government. So top 300 suppliers across all central government departments are now managed via a Crown Rep programme run by the Cabinet Office. And a lot of it is, I think it's about having visible objectives. You know what resource to put on it if you understand what our objectives are. You know what level of resource, what grade of resource, all those things are costs to your business. And if we're visible and upfront with you, then obviously it can help you make some business decisions. Big positive for suppliers is obviously you've got the ability to influence us. You've got the ability now to shape our requirements when previously maybe you didn't. It's just about you understanding that kind of the landscape's changed, really. What we expect from our suppliers, well, embrace competition. We're trying to break down all of those barriers. We're trying to make it that it's a level playing field. But at the same time, it's got to be embraced that that's what we're trying to do, and it's got to be embraced that that means that there will be better competition, which is obviously great from the suppliers, but it's also great from our perspective. We want you to make money, but not too much. There's also another set of reforms, the Lord Young reforms, to make it easier for suppliers to do business with government. This is a pretty key one, I think, particularly for a lot of people in this room. I'm making the assumption there's a lot of you that are SMEs, is actually cash flow is really important. We pay you within 30 days. In most cases, we actually pay within 5 days. Now, that's a massive, I would say, assurance from your perspective. So Contracts Finder, it's all the forthcoming procurement opportunities in Crown Commercial Services, but it will show you all of the contracts and all of the forthcoming procurement. So I'd highly recommend that you actually make sure that you're linked into Contracts Finder and that you're reviewing it. You'll see the opportunities there. It's free, so you don't even need to pay to get this opportunity. So really encourage you to sign up for that. At the moment, we are getting a lot of advice to move away from big long-term contracts. So there's a real big desire to disaggregate and to break contracts up into smaller lots, both from an SME perspective, but also to get us to be more flexible and agile. In summary, I think it's fair to say the commercial management landscape in government is changing significantly. We've done a lot, we've made a lot of changes, but we're nowhere near complete on that. It's continuous improvement, as it should be with any lean organisation.
My top 3 tips for companies wanting to bid and successfully compete on government contracts would be, firstly, to read the documentation thoroughly before starting the process. Secondly, to make sure they answer the question asked and not put in additional information or irrelevant information. And thirdly, to make sure that all the documentation and questions have been answered succinctly.
Today I'm going to be looking at financial reporting. I want to look at the profit and loss account, balance sheet, and also introduce cash flow statement. So we're looking at why cash is different to profit in certain scenarios. I also want to introduce key ratios both for the profit and loss account and the balance sheet. So we're looking at how the companies are measuring their performance. The second half of the day I'm going to be introducing cost classification and cost allocation, hopefully helping the students to make their financial case, and then moving on to evaluation techniques for evaluating projects. I joined the BPIF last July as Finance Director. The last 2 years I've been spending as a non-exec Finance Director to owner-manager businesses through various sectors. I've worked with B2B marketing agencies, security, automatic gates and aerospace. My main experience was really gained through 24 years as a main board director at a company called Colway Group. So I suppose a lot of the work that I'm doing now with owner-manager businesses are really helping them gear to sale and management buyouts. First of all, I'm going to talk about the two different sets of accounts that we have, a quick explanation of the difference between statutory accounts and management accounts. Then we'll have an overview of the profit and loss account, a quick look at an area of confusion between markup and margin, and then we'll look at the some key ratios around the profit and loss account, where we're comparing performances, certainly between two different companies. Then we'll move on to the balance sheet, and then I want to look at the cash reconciliation and explain why cash and profit aren't the same thing, and why cash is actually probably more important than profit. And management need a tool which is much better for them to actually manage their business with. And therefore, the management accounts tend to be much more flexible tool. They're often not restricted just to numbers. They will have sales performance reviews. They'll be looking at different areas of sales by salespeople, by areas. They'll also have an operational review and looking at key performance ratios within that. And therefore, they become a key part of control of businesses, and they should be a central part of any organisation. So I think the best place to start really is just to have a run through of the profit and loss account. This is a very standard layout. We will have a look at the actual budget and then compare the variance for the month. And then they also look at a year to date. But quite often you will also have a P&L which is monthly side by side, so that as the year goes on, you'll see each month and the trends which go in there. It'll be quite easy to spot variances. Looking down the rows, we always start with sales, which can be called revenue, can be called turnover, can be called income. And normally that will be invoice sales for the month. Then off that we have cost of sales, which comprises obviously the cost of materials used to actually generate those sales. It will also include any carriage charges on any raw materials, and some companies might actually want to show direct labour in there. By deducting cost of sales from sales, we end up with gross profit. Gross profit and gross margin can actually be confused. Gross margin can sometimes mean gross profit, but gross margin normally means the actual percentage, whereas gross profit is always the absolute amount. Below the GP, we actually end up with the overheads, which is all the other overheads associated with your business. But these will cover administration costs, establishment costs, and staff costs will include things like not just your salaries, but it will also maybe include staff incentives, obviously national insurance, pensions paid, training, staff recruitment, and things like that. And then I've separated out depreciation, which is amortization of any fixed assets you've got over a certain period of time. And then we have financial costs and interest. Below that, we then come to operating profit, which, as it sounds, it's actually the profit that you make from your operations. Deducting corporation tax, we then end up with a net profit, and the net margin is a percentage of net profit to sales. The two below that are EBIT and EBITDA. EBIT meaning earnings before interest and tax, so quite simply that is your operating profit and then adding back your interest. And EBITDA, which is earnings before interest and tax, depreciation and amortization. Margin, quite simply, is the sales price minus cost. In this example here, the margin would be £16 as a sales price, minus £4 cost, gives us a margin of £12. Whereas the markup is percentage of the cost price that you want to add to get your selling price. And we had a cost price of £4, and we wanted to mark that up by 300%. You'd multiply 4 by 3 to give you 12, plus the original 4 to give you 16. We often use ratios or percentages to evaluate the results and to make comparisons on how well we're doing. The most common ones, and these are really your bare minimum that we'd use, are the gross margin that we've already covered, which is your gross profit as a percentage of sales, net margin, net profit as a percentage of sales, Interest cover, which is quite often used, which is a measure of a company's adequacies of the company's profits relative to its debt. And the lower the interest cover, the greater the risk that the profit will be at, and will be less insufficient to cover the interest. Interest cover is defined as EBIT. So a value of more than 2 is normally considered reasonably safe. But companies with very volatile earnings may require a higher level of interest cover. 2 other key ratios would be turnover per employee. That's often used by management as a tool to gauge productivity. We'll be able to assess whether more people are required in the business or indeed whether we've got too many. Staff costs as a percentage of turnover. Again, that will really vary from industry to industry. A service company will have, with no raw materials, and are effectively selling their time, will have very high staff costs as a percentage of turnover, whereas a manufacturing company will have much lower staff costs. This is a typical layout for a balance sheet, actual, budget and prior year. It's very simply a snapshot of your company's financial condition at any one point in time. Most management accounts would look at monthly figures. So what makes up a balance sheet? Basically the top half of the balance sheet is made up of assets and liabilities, and at the bottom half is made up of share capital and retained profit. In turn, fixed assets are split into 2 types. We have intangible assets and tangible fixed assets. Intangible fixed assets are things that you can't touch. So the things like goodwill, which is value added to a business that reflects its name or its reputation or customer base. It'll include things like patents and trademarks. And tangible fixed assets are things that you can touch, such as plant and machinery, freehold property, furniture, etc. Current assets. These are quite often also referred to as liquid assets, and in the very broad sense they will comprise 3 items: stock of raw materials and work in progress. It will then also include debtors, and then finally a cash balance. Next we'd have current liabilities, which are liabilities due within 1 year. Creditors are the other side of the trade debtors really, so the main one in there would be your purchase ledger balances, so it would be the total of all the amounts that you owe your suppliers. But they'd also include things like accruals, so things that we've actually used but not received an invoice for yet. And then taxes due is always shown as a separate line, and that can cover all your sorts of taxes, your VAT, PAYE, corporation tax, etc. And then the other current liability might be your bank overdraft or short-term loans. And then the net of current assets and current liabilities is known as net current assets, or net current liabilities if liabilities are larger than assets. And the final part of the top part of the balance sheet are creditors due over 1 year. So there'd be your longer term loans or mortgages outstanding that are repayable for more than 1 year. And then the bottom half, that's made up of the share capital of the company and retained profit. And the great thing about a balance sheet is it always balances. So I just wanted to touch now on cash reconciliation, because cash and profit aren't the same thing. A company can be hugely successful and actually still fail if it doesn't have control over its cash. But if the company made net operating profit of 70, we'd add back depreciation because that's a non-cash item. So you'd add that back, and similarly you'd add back any other non-cash items, but that's the most significant one. And then we'd look at increases or decreases in working capital. Working capital is referring to our current assets and current liabilities. So if we've actually increased stock by £10,000, then that sort of means that we're not going to have £10,000 of cash in the business. Again, with debtors, if debtors have gone up by £10,000, then our customers haven't paid us that money, and again, it's not sitting on our bank account. Similarly, if creditors have actually decreased by £10,000, then again, that is money that has gone out of the business, and again, isn't sitting in our bank account. So from a starting point of £70,000 profit, I've actually generated cash of £100,000. But we've had to repay loans of £5,000, we paid taxation of maybe of £30,000, and we've actually acquired fixed assets of £50,000. So actually our net increase in cash for the business has just been £15,000. Capital expenditure is the acquisition of fixed assets for future value in the business. So it's for things which you purchase which are extending beyond 12 months. These items will be depreciated over the item's useful life and charged to the P&L. And it's the director's decision on deciding what the relevant depreciation policy is for the company. It will vary between various categories of fixed assets. For example, furniture might have a longer life than computers. A capitalisation policy will also be decided by your directors, and again it will vary from company to company. Capital expenditure minimum may be £1,000, so therefore a computer costing £800 wouldn't be capitalised, but a server costing £1,100 would be capitalised. So it's not just the nature of the product, it's also the quantum involved. It also could be flexible depending on what the needs of the company are. So if for whatever reason we wanted maximised profit, then if we were buying a bundle of, say, 6 computers at £500 each because we had a new department, there's an argument that you could bundle those together and put £3,000 straight into fixed assets rather than writing those off to the P&L in the year. So again, we can be flexible with CapEx, but generally it's a product over a certain amount which you will be using for future value within your business. And revenue expenditure are really your cost of goods sold plus all the other overheads which we looked at in the P&L. So if we're acquiring a machine through cash or loan, then that would definitely go as CapEx if it meets the minimum quantum. But if we're leasing that machine and it's just on lease rental and we're never going to own it, then it will always go to P&L. I'd say capital expenditure is written off over a period of time through depreciation or amortisation. And revenue expenditure is always written off to the profit and loss account in the period that it is incurred. So if we're just looking at machinery, your purchase cost, installation of that machinery and delivery cost can all be capitalised. Motor vehicles, which are purchased outright or through hire purchase agreements, will be capitalised. So any repair costs, any maintenance contracts or any rentals of machinery will go through as revenue costs. And similarly on motor vehicles, if they're used under a contract hire rental, or any repairs or licenses for the various vehicles will go through to revenue. What I would suggest when you're doing your paper is you set out very clearly the two types of revenue and come up with some very good examples. And it might be worth just speaking to your company's FD to ask what your company's CapEx policy is and the depreciation rates that they use. You might also want to refer back to the two types of fixed assets that we had, intangible fixed assets and tangible fixed assets, and talk a little bit about those. Also just talk about the main categories of overhead expenditure within the P&Ls, just so that you can really demonstrate that you have a sound understanding of the type of cost classifications and categories within the revenue and fixed assets. There are two broad types of costs for revenue. There are product costs and overhead costs. Within product costs are really just the two. It's cost of goods sold and direct costs. Cost of goods sold, with respect to, relate specifically to the cost of raw materials and for the items that have been sold. Either way, they will always include carriage or delivery costs on the items that are purchased. Direct costs, this can depend on company to company. They're sometimes included within cost of goods sold, depending on the type of industry you're in or whether management want to reflect them. But if they are, they will include things like direct labour costs for people directly involved in the production of those sales and subcontractor costs. So other costs would then all fall under the banner really of overhead costs. And the main categories we've got of overhead costs are administration costs, selling, establishment, financial and exceptional. I think exceptional is really a nice one to use for management account purposes. You can't use it for statutory account purposes because there are definite rules about what can be extraordinary costs within the statutory accounts. But for management account purposes, they're very useful for large one-off type costs which aren't normally involved in that type of business. And they can be shown separately in the P&L so that you can get an underlying profit trend, excluding those exceptional costs. Typically, they would include things like redundancy costs or reorganisational costs. And the other type of exceptional costs may be professional fees. If you had someone in working with you on a short-term basis who are completely outside your normal type of business, you can put those as exceptional. But again, these are for management purposes only. So I think when you come to look at your paper, I think it's very important that you try and show some sort of differences between cost of goods sold and overheads, and just come up with some examples from your own businesses really of where the costs are sitting and why they're sitting where they are sitting. So allocation of costs is often defined as allocating common costs across various departments or operations, and they will be allocated depending on the type of costs they are, and it can be very subjective, and it's also depending on why we want to allocate the costs. And the main purpose really is to see the profitability within a particular product or a function or division. And there are three types of cost allocation methods. But the three types are the direct method, where we can identify costs specifically for that function. The second method would be step-down or sequential methods. So therefore, with this one, you're assuming that there's other service divisions involved. If you've got HR and then you've also got finance, you might want to apportionate part of that HR cost to finance and then reproportion finance out to various divisions as well. And the final one, which you might come across if you do a bit of research on the web, is the reciprocal method, which is an extension of the step-down one, and it involves mathematical formulas, and it's rarely used because it's far too complicated, and you inevitably end up with a very similar result. Helping alongside that really are costing systems. But basically it's a system that will help management fine-tune their operations and help to cut costs, be more productive. The three main types are job costing, process costing, and activity-based costing. Job costing, which is materials, labour and overhead costs which are compiled for a particular unit or a job. And that works well when there's a unique product. Where you don't have a unique job, but you have a series of processes, then you would use the process costing system. When you're compiling all your materials, your labour, overhead costs, and they're added together for an entire process, and then you're allocating them to an individual production unit. And that works well when you've got large production runs of identical items, really. And that would work very well in print, so you'd often have process costing. Activity-based costing, and this came about because there was fears that the overhead costs were rarely allocated sort of properly, really, in an appropriate manner. And it involves a finer degree of differentiation between the overhead costs and those assigned to cost pools. You might want to introduce these three costing systems in your assignment just so that you're showing that you're aware of them. And again, when you're speaking to your FD, they may show you about how they're using process costing within their business. Broadly speaking, techniques for making a financial decision for evaluating a project are broken down between two types: discounted cash flow and non-discounted cash flow. What is discounted cash flow, or DCF, as it's always referred to? I think quite simply it means taking future revenue and costs into today's value of money. So it's also known as present value. But I think if we look at the more simple financial techniques, which are involving non-DCF techniques, the first one, which is the easiest to understand, is the payback period, which is the time that is required to earn back the initial investment. So if the initial investment was £10,000 and roughly speaking you were making £20,000 profit a year, it would take you 5 years to pay back. Return on capital employed. This shows how much profit is generated from each unit of capital employed. Again, this is a very good one for comparing one project against another. Cost benefit analysis, that compares the total expected costs of each option to expected benefits to see if benefits outweigh the costs and by how much. It's often used to estimate the strengths and weaknesses of alternatives, and it might also demonstrate the best use of labour and time costs. And whilst I've got it under non-DCF, it can equally be used under a discounted cash flow model as well. So you can use that under both tools. And the final one, which again is another simple one, is the return on investment. And that's the benefit or the return on investment divided by the cost of the investment, and that's expressed as a ratio. It's very similar to return on capital employed, apart from the fact that ROI uses net profit after interest and tax, whereas return on capital employed uses EBIT.